I'm Kevin Rudden, the principal assessor. This is Sharlene Harris, the principal clerk and one of the experts in our office, especially on the topic of exemptions. What we'd like to do, and feel free to ask any questions, is tell you a little bit about how the property tax process works. It's not as mysterious as people think. And then tell you about the exemptions that are available and how to apply for them.
Mm-hmm.
And please stop us at any time to ask questions. So how do you calculate a property tax? Believe it or not, there are two parts to how it's done. And the first part is actually all the voters' part. And that's you go to town meeting and you vote on the budget. And we don't have anything to do with that other than our department budget's included in the budget. But that goes through the finance committee and then it goes to the voters and you approve the operating budget. And the second half is our part, is we do the values. And we have to calculate the value of all different types of property, residential, commercial, industrial, tax exempt, and what they call personal property, which I'll explain. Unfortunately, residents don't get taxed on personal property, only businesses. So how did we get to the system we have today? How many people here remember when we passed Prop 2.5? Okay, that was in, believe it or not, the November 1980 ballot. And if you're younger than 58 years old, you weren't old enough to vote in that election. So I always gear my discussion of how the taxes got to where they were to people 58 and below get one story, and people above, like those of us in this room. Remember, what had happened a year or two before was you had Proposition 13 passed in California. People were very upset about tax rates. You had a woman named Barbara Anderson who passed away last year up on the North Shore, Massachusetts, started Citizens for Limited Taxation. She got all the signatures. She put whatever the question number was on the ballot, and it passed by the voters. And it took effect on July 1st, 1981, which in assessor speak was the first day of fiscal year 1982. And we call it Prop 2.5, not because that was the number, but because it limits the growth of something to 2.5%. So what happened when that passed? Well, we now have to value property at what's called full and fair market value. And a market value means what a willing buyer is willing to pay a willing seller, with no collusion, no anything. So if you put your house for sale and you asked for a certain amount of money and I agreed to pay it, you're the willing seller, I'm the willing buyer. And we base the valuation on those market values. And the easiest way to explain that is, if you looked at the absurd price increases during 20 and 21 with COVID, and they're leveling off in calendar 22, thank God, everybody's valuation went up, everybody's tax bill went up. I would also remind people that when you're in a downtime like the Great Recession of the early 2000s, values did drop and taxes did drop. Prop 2.5 also led to the fact that we have to update the values every year. So now how do you get the tax rate from that? Well, I said you vote on the annual operating budget. So that number gets reduced by state aid that comes from the state for schools and general government, what we call local receipts, but that's anybody taking out a building permit, paying for a liquor license, your auto excise taxes. We have 3 large solar arrays that pay what we call a payment in lieu of taxes every year. And then something the state calls new growth. The new growth is anything that was built but never taxed since the last assessment a year ago. And the money generated by new growth, not the value, but the money, the tax revenue from that new growth, reduces the budget as well. So what's left is raised by property taxes, and that's called by the fancy term of the tax levy. And it's the tax levy that can't go up by more than 2.5% each year under Prop 2.5. Not your individual tax bill, not the town budget, but the amount raised through taxes. So if you raised $1 last year was all the tax money you raised, the most you could raise the next year is $1.02. No, that doesn't make sense, but when you're dealing with a budget in the millions, it's significant. So, I'll give you a real life example. Fiscal year 22 just ended on June 30th. The town budget was $80,371,938.88. State and local receipts and new growth were $27,544,495, which meant what was being raised through taxes was $52,827,443.88. And it may surprise you that that was actually about $100, maybe $1,000 less than the year before. The town actually spent less through taxes. I don't know if that's going to happen for this year, but they did. So here's the simple math. You take that number, the 52 million, you divide it by the total value of the town, which was $3,039,553,733. And that simple math gave you a tax rate of $17.38. So when we get done with all the value setting and we get through the special town meeting in October, and we'll know what the total amount being raised through taxes is, you just divide that by the total value of the town, and that's the tax rate. So tax rates can go up or down, but the budget can go up or down, values can go up or down, state aid can go up or down. So it's very hard to predict what it's going to be every year. And that's why you may go, why did it go like this? Why did it go like that? I can tell you, and I don't take any pleasure in saying it because I'm a taxpayer, in my own town, the value still went up in calendar 21, which is the year we're basing fiscal 23's taxes on. They were still going up because of what I call the COVID factor. For 22, which is fiscal 24's tax rate and values, they're starting to go down. The big sales are leveling off. We still have houses selling for $1.3 million, $1.6 million in this town. We still have what 4 or 5 years ago would have sold for $300,000, selling for $600,000. There's nothing we as assessors can do about it. That's the real estate market. So what do we do with residential property, which is what we all own here? We look at sales that occurred 18 to 24 months before the current year. So again, for fiscal 23, which began on July 1, we're looking primarily at calendar 21 sales. But the Massachusetts Department of Revenue says you have to have a certain amount of sales in each category of residential, condo, commercial. So a lot of times we go back the year before. So right now we're looking at calendar 20 and calendar 21 sales to set the fiscal 23 values and tax rate. And what do we do with them when we have those sales? Well, the Department of Revenue plays a greater role in the tax setting than you could ever imagine. They give us a whole bunch of what they call ratio studies to look at. There's two principal ones. And one is we divide the assessed price of a house by the price it's sold for. And ideally, if we're assessing correctly, you should come up with a number 1. If we assess your house at $400,000, it should have sold for $400,000. Now, what's been happening during COVID is we have houses assessed at $400,000, and they were selling for $600,000. So that ratio that I mentioned has to be between 0.9 and 1.1. So 0.90 to 1.10. And our goal is always 0.95. Okay? So we have to raise the assessments to get that ratio equal that. On top of that, there's a very weird mathematical term called coefficient of dispersion, which thank God is built into spreadsheets because it's You do column after column after column. But basically, it has to be smaller than 10%. And the lower the number, the more uniform your assessments are. And that means the closer they are together, and nobody's way up here or way down there. So we do that with the sales. But we also have to look at, are they what's called arm's length? Remember I talked about a willing buyer and a seller? Arm's length means there's no relationship. So if I were to buy your house and I were your cousin, your child, that's not arm's length, so that doesn't count as a official sale for us. We look at what's going on the property, a condo, a multifamily, commercial, industrial. For houses, we have to look at all the different styles. Cape Cod, colonial, contemporary, you name it, we look at it. Log cabin. The year built. The size of your lot. The size of the house in square feet of living area. The neighborhood you're in. And neighborhood does not mean the street you're in. It means what characteristics do you share with like properties around the town. So houses on Highland Street, Concord Street, and Washington Street, and Norfolk Street, it's the very busy roads. In our part of Summer Street, they're a neighborhood to themselves. Okay, whereas a secondary street might be grouped with the same type of street all the way across the town because they share characteristics of traffic or years built or styles. We also look at the date range the house was sold in. Believe it or not, prices climb from January to August. And most of the sales occur June, July, August. Why? Because families want to have a new house to put their kids in the school system. And then they start dropping down in August, September, October, and prices drop. And we also have to look at what's called the price quartile. What range did a house sell in? Is it in the $250,000 to $500,000 range? Is it in the $500,000 to $700,000 range? And we have to make these ratios work for all of those properties. And it's not easy, but we get there. Okay. That's what I call a very small model of the town, is those sales. When we get all those in those ratios that the Department of Revenue wants, we then apply those sales factors to all the other houses in town by neighborhood, style, whatever. And then we go through all those ratios again for the whole town and make sure they balance correctly. That is called by the term mass appraisal. We're looking at the mass of houses in the town by groups. And that's different than if you hire an appraiser to get a value on your house, because they're looking at one house and comparing it to others in the area to come up with one value. We're coming up with values for everybody. So when you hear the term mass appraisal, mass does not mean Massachusetts. It means the great mass of houses through the town. Okay. Commercial and industrial properties are valued differently than houses. Houses are valued by what's called the sales approach, what did it sell for, and the cost approach, what would it cost me to rebuild it? If you have homeowners insurance, they go by the cost approach. You have a 50-year-old home, it's been depreciating for 50 years. No matter what your policy says, they'll say it's only worth this if it burns down. But they have to look at the replacement cost to build it. And lumber and things are a lot higher. So they may say, gee, your house that burned down was only worth $100,000, but to rebuild it today is $400,000. So we look at that in valuing property. If lumber prices go up, values also go up. Commercial and industrial property is valued a completely different way. It's called the income approach. And the income approach is, how much money can this property generate? And you subtract vacancies. So if I own a warehouse that I've broken into 4 pieces and only 3 are filled, I have a vacancy, it can't generate all the money. Minus the operating costs. If I own an apartment building, I have landscaping, I have property taxes count, I have insurance. You take that all away and you come up with a figure they call net operating income, and you divide that into the factor of what it costs them to borrow to make that investment. And that's called the capitalization factor. And when you divide those two, you come up with the value of the property from an income standpoint. That's why you can have a property worth, there's one commercial building in town that's worth $46 million, which is the large marijuana growing facility on Hopping Brook Road. And you can have another worth $10,000 that's much smaller. Okay, and then the business owners also pay personal property. And the easiest way to think of personal property is if you go into a restaurant, it has tables, chairs, kitchen. Barber shops and hair salons have chairs, sinks, those things. Stores have shelves and cash registers. Landscapers have the mowers, the blowers, the trucks. That's all their personal property. That gets taxed. In Holliston, if you have less than $5,000 of personal property, which is most of the smaller businesses in town, they don't pay personal property taxes. So we get done with all that, and we have all these forms to fill out for the Mass Department of Revenue, and they check everything we do, and by everything I mean line by line. They've been known to come back and say, why is that house valued at that much? That doesn't look right to us. Trying to think of some examples they do. You can value a built-in swimming pool, an in-ground swimming pool. You can count as new growth, but you can't count an above-ground swimming pool as new growth. They'll look at things in new growth and say, someone started a condo this year and finished the whole thing and sold it for $800,000. So we're claiming $800,000 in new growth. They might say, but you had two other condos with the same street address also built this year, and you only said $750,000. Why? Well, they were built earlier in the year and sold for that. And there is a development in town where in January of 22 they were selling condos at $700,000, and a month ago they were selling condos, the same building, at $850,000, and people were paying it. So that's different. So they check new growth, they check all those ratios, they check our tax rate calculations. The town accountant has to give them all the budgetary info from the town meetings. And if there are any town meeting votes related to this, like Prop 2.5 or anything else, to spend money, they get that from the town clerk. So that's a lot. That's primarily what I do most of the year.
Yes.
But typically from town meeting time until October, November, I'm stuck doing spreadsheets. That is my job. We have other people going out, look at the properties. We have other people doing that. But we also want to talk about exemptions, because every assessor in the state, and I belong to the state association, and I'm a committee chair in that, I can tell you we don't sit around going, oh boy, let's tax them out of their houses. What we really do is sit around and go, what can we do to help people who are getting driven out of their houses by high taxes? What can we do better in our cities and towns? What can do better at the legislative level to get bills passed to help people? Because if you haven't noticed, Sharlene and I are seniors too, and we're in the same boat. We just happen to be working. But, I live 2 towns away. My taxes have gone up from the low 4,000s a year to well in the mid 6,000s in the last 8 years. It's a lot of money. Right, and Holliston has higher values than Mendon, where I live. And, I look at the values, and every year I look at, and I don't, candidly, no assessor ever got up in the morning and said, who can I throw out of their house today? I don't really, my job is not to raise money. My job is to make sure values are fair and equitable. But unfortunately, across the Commonwealth, in fact, across the country, COVID has really hurt the senior community. And I want you to know that the assessing community knows that. We're doing whatever we can, wherever we can, to help. You do have some exemptions that are available now. They're set by the Mass state laws. Charlene's going to go into depth with them in a minute. We'll talk about them. They're not automatic. You have to apply each year. But I also wanted to let you know that there's a place in Cambridge called the Lincoln Institute of Land Policy. And the only thing you need to know about it is they study land and taxation around the world. They just did a 10-year study about what are the best ways to give property relief, property tax relief to homeowners. The book literally came out this month in print. I've got a little picture of it there. For assessors, they let you download it for free. So I downloaded it last week and took it home and read it because they say, what are the best practices to help the seniors? And I'd like you to know that based on what this independent group recommends, we're doing 95% of it in Holliston already. And we want to make sure you know about that. The 5% we don't do, you can do. And that's, they recommend, we'll talk about the other things they recommend. But one of the things they recommend doing is it's harder for people on a fixed income to pay that quarterly bill all at once. But you can divide it and pay it monthly. Still doesn't lower it, but it might make you help your budget easier. I don't know if the tax collector is ever going to get around to issuing monthly bills, but when you do get a quarterly bill, they have to accept a payment. And I know one of the things my father taught me a long time ago is I don't have the bank take out in escrow my tax payment, is I write a check every month and stick it in a drawer for my property taxes. And then when it comes time to pay them, I've already taken it out of my checkbook and the checks are sitting there, so all I have to come up with is that last monthly payment. And that's helped me. But we're going to talk about the exemptions. Just the other thing that we're working on is the Mass Assessors Association has a bill going through the state legislature right now to get another exemption passed just for seniors. And it's based on the, if you're familiar with the state income tax, has the circuit breaker exemption for seniors. This is based on that. And if you qualify for the circuit breaker, you'd qualify for that and get the same amount of money off your taxes. Right now, that's $1,170 is the full credit this year for calendar 21's income tax. If the town had the exemption now, they could offer you up to 200% of that if this bill had been passed. So $2,200 off the, math, 2340?
Sounds about
2340. I do better on the calculator. But that would be $2340 off people's tax bills if we had it in place today.
significant.
Not
Very
wanting to be out, and still apply for the other exemptions, by the way. Not wanting to be outdone at our town meeting this year in Holliston. The voters authorized the exact same bill, but for Holliston only, and that's going parallel through the state legislature. It takes about a year or two to get a bill through the state legislature, but so we're trying to get it on the state level, and then the town would vote to accept the state law, but not willing to wait for as long as that may take. We're also doing our own version that if it's passed, we could offer that immediately. And that's something we're trying to get to everybody because we're very well aware of the effect the high taxes are having. Now, Charlene's going to talk a little bit about the exemptions that we offer, and then we can talk about how you can apply for them. Sharlene, why don't you talk about exemptions?
I shall. I'll be pleased to do that. My portion of the program is a little less technical. I'm going to be referring to a pamphlet here that at the end of the presentation I'll be giving to you each to take home. And the title of it is, Do You Qualify to Lower Your Property Taxes? So this indeed explains the various exemptions that we have in our town to help with your property taxes. In general, they're all based on age and income. And so we'll go through them. And again, I will take your questions too at any point. And we'll see how it goes. All right, so in our pamphlet, the first one that's addressed is for the elderly, okay? We call it our elderly exemption. You need to be 70 years of age, so there's the age requirement for that one. And there are requirements for what your income and assets are as well. One's income, these figures are pretty low, but one's income cannot exceed, if you're a single person, $20,000, or if you're married, $30,000. And your assets cannot exceed $28,000 for a single person and $30,000 for married. And you must have lived in the house at least 5 years.
I have a question.
Yes.
When you say assets, you're not including their house, are you?
No, thanks for pointing that out. No, your primary residence is not included in your assets. And neither is your car. That was something that Colleen talked about the other day. Neither is your car, your vehicle. So it's things like, your bank accounts, that sort of thing, primarily any savings certificates, that sort of thing. All right, so that actually, we do a fair number of those in our office. If by chance you fall into this age category of 70 and over, but your income is higher. Oh, and let me back up. Let me tell you how much you save, because that's an important point. If you apply and qualify for that first elderly exemption that I described, the deduction from your taxes is $1,000. So that's significant. If, however, you don't qualify for that because you make more than the stipulated amount, we also have a secondary elderly exemption. It's for widows, widowers, persons over 70, also a minor surviving child. And this is worth $350 off of your taxes. And it is based solely on your assets. It is not income based at all. Assets cannot exceed $40,000. And you must have owned and occupied your home for at least 10 years. And again, there is no income limit at all considered for this. Before I tell you about what's required to apply, let's just keep going and with this description of the various programs that we have. One of the ones that we take in a lot from our residents in the town are for disabled vets. And year to year, we have a great number of these that come across our desks. A disability can be anything, any kind of medical issue that you have that develops as a result of your service. So it's not necessarily all the extreme things that you might be thinking of, but obviously those are included as well. And the veterans exemptions can run anywhere, well, generally $800 to $2,000, although some of the extreme ones do exceed the $2,000. You have to have a letter from the Veterans Department that does designate you as a disabled vet. And don't forget that, if your husband, was disabled, passes away, you are eligible as a surviving spouse to continue to avail yourself of this exemption. We have an exemption for blind folks. If you are legally designated by the Massachusetts Commission for the Blind as being blind, you are issued a certificate that states that, and you're able to apply for the blind exemption, which is $875. Let's jump to tax deferral. There's an exemption and a program for tax deferral. You only have to be 65 years of age to qualify for this. And there's a process whereby you will fill out the application with the additional documents that are required. And if you are approved for tax deferral, that means the first year you apply, that is a blanket acceptance, okay? It means going forward, you have that opportunity to file each year for the program. Some years you might be able to meet your tax obligation. Other years, you know, the amount you want to defer might vary according to your situation. But basically, there's a lien filed on your home by the town so that we can then collect what is owed to us at the time the house is ultimately sold and or there's an estate that's settled and the home is sold. So the taxes accrue at a rate of 6%, so that's what the town gets for making this available to owners. And as I said, the amount you defer can vary from year to year. You're in control of that. So that is really a good program and something that more folks, I feel, should consider. Because again, if you apply for it and you're accepted, it doesn't lock you into anything. You're in control, but you know you have this to fall back on if hard times come or, you know, if you're really stretched for whatever reason. There's one called hardship, which I'm going to ask Kevin to go into. And do you want to do that now? Or
Yes.
Okay. He's going to handle hardship.
Hardship exemption is different than all the rest because it's left up to the, well, let me go back. If you meet the criteria on the one Sharlene mentioned, the Board of Assessors votes on these. They meet every week, by the way, so if you put in an application, it doesn't sit forever. As soon as we process it and say you met it, we take it to the board the following Tuesday. It's approved. The hardship is a little different because it's subjective to what the staff, meaning Sharlene and I and the two other people in the office, recommend to the board. But it's a way of looking at for people who are really don't have a way to pay anything and have expenses. It's a way of having the tax bill just wiped away for that year. All or in part. The board is in the process of approving, and hopefully tonight they'll do it, a revised guideline for that puts in writing what you need to do to qualify for it. It's really been, over the years, a little bit more subjective than it should be. But it's, I could give you an example of a hypothetical case. We have some seniors in the town who, for whatever reason, wound up borrowing off their house or off a credit card. And the mortgage payments or the credit card payments are basically, along with their monthly living expenses, are reducing them to nothing. That's a candidate for hardship exemption. And we want to protect those people. You know, the town has no desire to kick people out of their house in that regard. So typically, if people meet the criteria we have, we grant the hardship. There's about 8 of them a year granted. They're individual. The thing you need to also, although you have to do financial means for all of these things, all that data is highly confidential. I mean, nobody wants their matters, told by anybody. They're kept under lock and key. The only people who see them are the staff in the assessor's office. The board itself, unless they specifically inquire about a case, does not even see the numbers. We give a recommendation and they just approve them. the typical question is, do they meet the criteria? Or if I present 4 or 5 to the board, it's, these all meet the criteria. And then they're voted on. I know that's very important to people. The hardship ones especially, those, you know, and I will tell you, they break your heart when you read them. You know, when you see somebody living on Social Security and owing $100,000 at a certain age in life, it's just, you know, you want to make sure they get taken care of. And if you notice, I'm choking up a little about this. I mean, I don't want to see anybody, you know, in that position with the threat of losing their house or something like that. So we make sure that people who apply get looked at carefully and get brought to the board. The other factor with all of these would like to mention is, in the past we haven't been saved. First of all, if you got one of these exemptions last year, we've already sent you an application. We automatically send applications out every year to people who had them the year before. Mm-hmm. So I know they went out in the mail last week.
Mm-hmm. We've already got some back.
Right, the fiscal year starts in July, so we're mailing them out a little bit later than that. And I know when people have been going in across the hall from us to pay their first quarter taxes, we kept hearing, well, when can I get my exemption? So next year we're going to mail them out a little earlier.
And in fact, if I can interrupt, what we did this year was mail them out earlier than last year. You know, last year we were doing it in October, so we're up a month.
Yeah, but we want to try to do is help everybody who qualifies for exemption get it so that it's entered into the tax collector's system when those final 2 quarter bills come out. It's in there and taken care of. Because I think it's a hassle for the seniors who qualify for these to go through 1 or 2 or 3 quarters and not have it, and then get it all reduced in that last quarter, because it means you've had to pay a little higher in the first 3 quarters. So we want to try to help people get it in with the goal of this year and going forward of getting them all approved by the time that 3rd quarter bill goes out, which is the January 1 bill, with the final bills with the real rate and the real values and that. So that's one of our goals going forward. But hardship is what the word implies, which is people who are really in a hardship mode. The other thing I'd like to talk about is the deferral. The only thing we'd ask as an assessor, if you get a deferral and you have arrangements already or know where your property's going, like you plan to leave it to a child, if you have, you know, if your spouse is gone, and let them know you've gotten it, because the problems we have come afterwards, which is the heirs come in and say, I thought my blank's house was worth $500,000. Why do I owe you $300,000 in back taxes? And the answer is, well, your relative was too proud to tell you they got a deferral. We just ask that you let them know up front, because it solves a lot of issues afterward. But there's no requirement to do that. But it's the only downside comes afterwards. We see that, is people come into the town and go, well, they never told me, or they never do this. But if you're eligible, we'll help you get it, trust me. If you are eligible for any of these exemptions, we'll help you get them.
Oh, absolutely. To wrap up a little bit on my presentation, again, I'm going to give you one of these. The first step is always to reread it, make sure, yes, I qualify perhaps for this, but no, I don't. Once you make that determination, you can stop by the town hall in our office to pick up an application, or give us a call, and I'll be happy to mail you whatever you need. Our phone number is right on the back here.
Thank you all for coming.
Thank you so much.